Welcome to the Explainer. So, you know that feeling when you first pull up an option chain and it's literally like you're staring into the Matrix? Just rows and columns of flashing numbers that seem to speak a completely foreign language? Well, today we are going to decode that language together. We're going to master the hidden dynamics of open interest and volume. And I promise you, by the end of this, those numbers won't just be random data anymore. They're going to tell you a really compelling story about exactly where the market is heading next.
Here is our game plan for today. We'll start with the foundation, move on to decoding futures, translating options, combining it all for sentiment, and wrap it all up with support and resistance.
All right, Section 1, the foundation, OI and volume. Look, before we do any heavy lifting with market analysis, we absolutely have to lock down these two critical metrics.
Let's kick things off with open interest, or as you'll usually hear it, OI. As a quick mental model, I want you to picture the market like this massive retail store. Open interest is simply the total number of items customers have bought and are currently holding. They haven't been returned, they haven't been consumed, they haven't expired, they're still out there in the wild. In the market, it's just the total number of contracts that are still actively being traded. Every time a brand new buyer and a brand new seller shake hands, boom, open interest goes up by 1. If they both decide to close out their positions, it drops by 1. It's essentially a raw head count of the active participation in a specific contract.
Now let's flip over to volume. If open interest is the inventory currently held by customers, volume is the daily foot traffic actually walking through the front doors. It's the total quantity of transactions that happen during a single session. And here's why you need to care about this. Volume proves liquidity. If a contract has super high volume, it means there are plenty of active buyers and sellers in the room. That ensures you can jump into and out of your trades really easily without getting squeezed on wide bid-ask spreads.
Now, let's clear up the biggest misconception that always trips up newer traders. Because these terms kind of sound similar, people tend to confuse how they behave. But here is the golden rule you have to remember. Volume only goes up during a trading session. Every single trade just adds to the tally. But open interest, that's a different beast. OI can go up, it can go down, or it can just sit completely flat, depending entirely on whether those trades are opening brand new contracts, closing old ones out, or just passing them along to somebody else.
Let's actually look at how this plays out step by step over a 4-day scenario. It's like a puzzle. On day 1, Trader A buys and Trader B sells. They just established a fresh position. So, open interest is 1, volume is 1. Simple enough. On day 2, traders C and D jump in and make some additional deals, creating 3 new positions. So our open interest climbs up to 4, and volume is now 4. But watch day 3 really carefully. Traders A and D decide to square off their old positions. Because they exited, open interest actually drops back down to 3. However, since a transaction happened to close those trades, volume ticks up to 5. And day 4 is the perfect illustration of that transfer mechanic we talked about. Trader C wants out, so he sells his 3 contracts to a totally new guy, Trader E. The open interest stays absolutely flat at 3 because the active contracts just changed hands, but the volume, it jumps to 8 because 3 brand new transactions took place. Make sense?
Okay, moving right along to Section 2, decoding futures open interest. Now that we've got a solid grip on the basics, let's actually pair this OI data directly with price direction to see what it tells us.
Professional traders look at these 4 core scenarios to figure out if a trend is real or if it's just noise. Think about it. If the price is going up and open interest is rising, that means more people are actively pouring money into long positions. That's a serious, building bullish trend. On the flip side, if the price is dropping and open interest is rising, traders are aggressively piling into short positions. That's a building bearish sentiment. So rising OI always means the trend is gaining steam. But what if OI is dropping? Well, that signals a reversal. If prices are climbing but OI drops, short sellers are panicking and covering their positions. If prices fall and OI drops, buyers are throwing in the towel and unwinding their longs. Basically, dropping OI screams that the current price move is running out of gas.
Section 3, translating options open interest. I know. Options data can give people a massive headache. But stick with me, because we are literally just taking the exact same logic we just learned and pasting it into a new context.
Check this out. It's fascinating how the exact same mathematical behavior creates completely opposite market sentiments depending on the type of option. Let's say you're looking at a call option. The premium is going up and the open interest is going up. People are clearly stacking up long calls, so that is heavily bullish. But look at a put option. The premium is rising and open interest is rising. Now traders are stacking long puts, meaning they're betting on a drop. That is heavily bearish. You're seeing the exact same data behavior, price up, OI up. But because calls and puts are opposites, the market sentiment is completely inverted. You've got to keep that straight.
All right, Section 4, combining data for sentiment. Because honestly, just staring at the call side or just staring at the put side, that's only ever going to give you half the story. To truly read the market's mind, we have to look at both sides simultaneously to find the consensus.
Imagine you pull up the option chain and you spot this specific combination. On one side, you've got a call long buildup. Buyers are aggressive. They desperately want the market to rise. But then, on the other side, you have a put short buildup. Option writers are stepping in, effectively shoving the price higher from below. Guys, this is the perfect bullish storm. You've got both sides of the market totally aligned, working together to drive the price through the roof.
But what happens when the option writers completely take over? If you spot a call short buildup paired directly with a put short buildup, well, the market is completely trapped. The call writers are putting a ceiling on the price, preventing it from rising, and the put writers are putting a floor under it, preventing it from falling. You get this incredibly boring, range-bound sideways market. Usually it takes a sudden shock, like a major news event that causes spikes in the India VIX, to actually break that gridlock. And a pro tip here, sitting on your hands and waiting out a sideways market is always better than entering a bad trade.
Which brings us to Section 5, identifying support and resistances. This is the practical climax of the explainer. This is where we take all this data and use it to pinpoint exact mathematical price barriers.
The option chain actually hands you the market's boundaries on a silver platter, as long as you know where to look. It's super straightforward. The strike price with the absolute highest outstanding call open interest, that acts as a massive resistance level for that expiry. The strike with the highest put open interest, that's your rock-solid expiration support. And if you're day trading and looking for short-term intraday levels, simply hunt for the strike prices that are experiencing the biggest change in open interest on that specific day.
To really utilize this, though, you have to get inside the heads of the big players. You need to understand the psychology behind these massive open interest levels. Why does a mountain of call OI act like a brick wall? It's because option sellers are acting as a physical barrier to price movement. They park their money on that specific strike because they are absolutely convinced the price will not cross it. They're putting serious capital on the line to defend that territory, functioning as a massive roadblock until they get liquidated.
Let's make this real. Let's look at the mathematical tension on a real-world index to see how these barriers finally break. Say the Nifty is currently trading right at 17,700. You check the chain, and your biggest put support is down at 17,500, with an option premium costing 60 rupees. On the upside, your huge call resistance is parked at 18,000, and that premium costs 40 rupees. So right now the market is just ping-ponging between these levels. The sellers are totally comfortable. But these barriers will eventually crack, and they crack when those deep-pocketed option sellers get backed into a corner and start bleeding money.
So let's do the math on the exact breaking point for our resistance level. The call sellers fiercely defended the 18,000 strike, and they grabbed a 40 rupee premium to do it, right? So 18,000 plus 40 equals 18,040. That right there is their mathematical line in the sand, their break-even point. If the Nifty pushes past 18,040, those sellers are officially in the red. And what happens? Absolute panic. They are forced to aggressively buy back their positions just to cover their shorts. And that frantic short covering acts like rocket fuel, launching the index even higher to 18,100 or beyond, triggering a massive, explosive price breakout.
See, when you combine open interest, volume, and just a tiny bit of basic math, you literally get X-ray vision. You can see exactly where the market is fortified and precisely where it's going to snap. You're no longer just staring at a confusing wall of numbers. You are reading the real-time intentions, the fears, and the breaking points of thousands of traders. So I want to leave you with a bit of a provocative challenge. Now that you actually know how to decode this hidden language, open up your trading screen right now. What is the option chain telling you today?